All right. Good morning, everyone. Thank you for coming. This is the report of fiscal 26. Okay. Are we good now? Okay. Thank you. Just a few numbers to start with. Pre-tax profit is up to 27 million. Profit after tax is positive break even. This is in line with the post-close statement we issued. EBITDA is up 16% year-on-year. We've seen that underlying terms, the business is moving in the right direction. We carried 70 million passengers. That's a 10% uplift on this metric. We are over 2 billion euros of cash, and net debt is unchanged, but leverage has come down from 4.4 to 3.7 again. I think that's showing that we are heading the right direction here. Liquidity ratio is one of the highest in the industry globally with 36%, and that's an improvement year-on-year. Maybe a few highlights in terms of what is underpinning the business as we speak. We think we have a good growth momentum. You recall that we had to hold growth due to the engine groundings around 2 years ago. We have started recovering from that situation. You see that the number of aircraft on the ground due to the engine inspections has been coming down, 42 last year, 30 this year. We also think that the market will be favorable for this, especially going into the second half, because we know that under the circumstances, the market will become somewhat distressed. The industry will come on its back foot. What happened during the COVID recovery, agility plays a role. If you look at Wizz today, we are double the size of what we were pre-COVID. This is to a large extent contributable to some market acquisition acts what we undertook at that time, and we are possibly seeing similar opportunities here. As said, the GTF is still around. This is an issue which we keep carrying on, but we have kind of 18 months to go with that regard. We have been on plan to deliver the uplifting targets, and for 6 to 8 months, the plan has not changed. We have growing confidence that this is going to get completed as anticipated before. We are still expecting that by the end of 2027, calendar 27, all aircraft will be lifted and will be flying. Of course, there is going to be more technical backing to the GTF operation in the forms of spare engines, but there won't be aircraft on the ground. We are much focused on managing capacity and growth in the remainder of the summer period, as well as looking into the winter period, where we are not in a position to guide given all the uncertainties, and with that regard, we are falling in line with the industry. But when you look at growth, I think you should appreciate one nuance, that ASK growth is quite different from seat growth. And this is the result of long stage length capacity having been removed, that's Middle East, and reallocated in Europe, which is not shorter stage lengths, producing more sectors. Now, the good news is that when you are growing through sector productivity, effectively you are delivering that growth at around 30% lower cost, simply because you don't have to absorb fixed costs to that growth. It may feel a high number, but a chunk of it is actually coming in at very low cost, lot lower cost than otherwise. And we are at around 25+% growth to be delivered on seats. If you kind of break it down to ASK, you recall that we were guiding actually capacity of the first half of fiscal 27 to be around 20%. It is 15% in Q1, and it's going to be around 20% in Q2. The lower number for Q1 is the grounding of the Middle Eastern capacity, but in Q2, all that grounding has been uplifted and reallocated predominantly to Europe. And we have started reinstating 30% of the Tel Aviv capacity as well, but most of the Middle Eastern capacity is now flying in Europe. Let me just reiterate the medium-term expectations from the business. We have been discussing this, but I would like to reconfirm this. We are looking at 10% to 12% medium-term growth. You recall we said that this year will still be high growth, but we affected the aircraft delivery program with Airbus to get this moderated growth rate to kick in as of the next financial year. We are improving network densification. That's relevant because especially if you look at where we are growing in Europe, we create more sectors, we create more dense products that attract more business passengers, higher yielding passengers. That also improves the revenue line, not just the network integrity and the operational metrics. We are coming to the end of the A320 CEO cycle. We still have roughly around 20% of the fleet to be recycled. That will get completed over the course of the next 2 years. So in a way, if you really think about this, in 18 to 24 months, you will have the stars realigned again, having the whole fleet flying and having basically the whole fleet converted into new technology aircraft, A321, creating significant economic efficiency. So next slide, please. Let me just recap where we are at on the strategic initiatives. So we were discussing this around some of the underperforming parts of the business. We closed Abu Dhabi last year. We closed Vienna earlier this year, and we are rigorously reviewing our performance in light of profitability as well as in light of cost of doing business, especially the high-cost airport environment. So you may expect some more to come with that regard, but we are clearly addressing these structural issues in the business. Airbus order book, we have communicated that it is already set for accommodating the medium-term growth expectations that will kick in as of next financial year. We have shifted the delivery lines on the existing order book. We expect to have 335 aircraft by the end of fiscal 30, so in good 3 years from now. That will deliver 7% fleet growth, around 11% seat growth. Now, the difference, of course, is that we are lifting the grounded aircraft due to the GTFs that creates growth capacity for the business. And I think that is in line with our previous communications of how we are seeing the next few years to play out. XLR is over, to put it very simple. We are no longer pursuing an XLR soft fleet or an XLR network. Effectively, the 11 XLR aircraft are forwarded into the A321neo operations. It is a little higher unit cost as a result of the weight of the aircraft, but still lower production than the A320ceo. So this is not like a bad aircraft. I mean, this is a good aircraft. And it creates, as we said, operational contingencies for the business. So should we have airport closures and detouring and stuff like that, you don't have to land for fuel stop, but you can continue with an XLR because that gives you more range. But as such, XLR operation is over. So we are not talking about XLR any longer. We are not talking about an XLR network or an XLR soft fleet or a specific operating model for XLR. It's all forwarded. Then you look at the network realignment. Quite a year behind us, and kind of in front of us, we have made announcements of a number of new bases. 8 bases were opened in Central and East Europe. New Italian bases were added to the system like Torino and Palermo, and we continue the densification of the network, delivering more sector productivity on the one hand, but also creating the opportunity for tapping into higher yield demand as discussed before. The GTF related on parking of aircraft, we are down from 42 last summer to 30 this year. due to the powder metal issue. You recall that all of a sudden started affecting the business good 2 years ago, and as I said, another 18 months to go through this cycle and get out on track to deliver that. And with regard to fleet technology, as you know, we are doing two things in parallel. We are renewing the fleet from CO to NEO on the one hand, and we are engaging the fleet from AC20 to AC21. Those two initiatives go hand in hand with each other, and in about 3 years from now, the fleet will get converted into AC21 NEO effectively. And with that, I would hand it over to Veronika.
Yes. Thank you, Joe. Good morning, everybody. For those I did not have a pleasure to meet yet, I'm Veronika Špaňárová. I'm CFO of Wizz. I have been 4 months into the job, which in the dynamic world of aviation seems much longer than that. But it's great. I'm also glad that Jan is here. Jan was in my seat for the past couple of years. Has been promoted to the role of Chief Commercial Officer, but has been great help and support for me in my first weeks and months of the role. So what I will do is I would like to summarize the S26 financials, and then Jan will talk about our commercial initiatives, and then we'll be happy to take the questions. So in the nutshell, what do we see in the F26? I think that there are two messages that we would like to point out. We continue execution on our strategy, which is the focus on the core markets in the Central and Eastern Europe. And I also believe that you do not see any surprises in the numbers. This is what we have communicated before. Couple of things to point out on this page. Solid revenue growth year on year by 8%. This is a combination. We see the ASK increase of 8.5% and the seat capacity growth of 10.5%. And this is what Joseph was alluding to as well. The difference between these two capacities show the impact of the higher gauge aircraft and also 1.8% reduction in our average stage length. And again, that goes back to the deliberate network refocus to densify the routes in our core Central and Eastern European markets. RASK and the load factor were broadly flat year on year. This is in line with the outlook and with the guidance which we gave before. And EBITDA margin increased by 1.6 points to 23.2. With this is highlighting the cash generative ability of the business. If we go to the next page, please. I'll be talking. Let me walk you through the main messages of the cost. Again, no surprises here, and we are being consistent with what we have communicated before. A couple of highlights, which I would like to make. Total fuel costs. You see a decrease of the fuel costs and notably decrease in the fuel unit cost by almost 10%. And it has two factors in that. We are talking comparison F25, F26. The market prices decline in that period, but also I would say very importantly, the increasing efficiency of our fleet and the resulting lower cash fuel burn as we are renewing our fleet. NEO aircraft is now accounting of 77% of our fleet. You see an increase in the maintenance costs. Here, I would like to point out that this is largely due to the fact of the 83 million accrual reversal, which we have seen in F25. So that's increasing the year-on-year comparison. If we look away from this accrual reversal, the maintenance cost would be about 3.2% up. Depreciation also was higher in the line with the expectation, and this is reflecting the redeliveries of the CEO aircraft and the resulting capitalized costs. On the other costs, what I would like to mention, two things. We see the higher sale and leaseback year over year. We saw in F-26 33 aircraft and 18 engine sales versus 16 and 10 respectively in the F-25, and that is helping to offset the fall in the compensation costs as our aircraft are gradually ungrounded. What is positive, what I would like to point out here is the decrease in the disruption costs, which is reflecting very well on our operating performance. And the next slide, please. So with regards to F-26, we generated almost 1 billion of the free cash flow. This is 22% increase year-on-year, and this is even after the repayment of the bonds of 500 million, which we did in January 2026. Net capex benefited from the adjusted PDP schedule and the timing of the sales and leasebacks. You see the improved leverage with the net debt to EBITDA going to 3.7 times from 4.4. Final point which I would like to make is around our hedging position, which as you know, we have the hedging policy and program that we are executing on. At this point, as of May 29th, our first half F-27 jet fuel needs were hedged 84% with a cap of $826 per metric ton, and the winter hedge position for the second half of the year stands at 71% with a cap 819. Also, apart from hedging the jet fuel costs, we are also hedging the FX exposure, which is now loan book is now hedged up to the 83% of the US dollar lease exposure. So this would be the main highlights, and now I will pass over to Jan. Thank you.
Thank you, Veronica, and welcome. Good morning. On the next slide, we've spent a lot of time hearing people in the industry talk about what the change in consumer behavior has been following the Iran conflict. And people have said, oh, people are waiting and seeing and booking later. And I thought that was rather anecdotal. So I wanted to pull some data just to see exactly what was happening and also to track that behavior going forward. So you can see that in January, this is a shift in RASK generation. This is not changes in RASK, in absolute terms RASK. This is when the RASK is generated through the booking curve. So in January, for example, you can see that in the dark blue bars, we were seeing almost 1% of people were booking earlier in the 3 to 8 week period, and fewer people, less than 3. There was a decline of 3.3% of people booking in the last 2 weeks. So people were booking earlier in January and February, which makes sense because people were coming out of winter and starting to think about what's happening in spring, and because of the changes and the deliberate modifications of the network that we've been making over the year, of the last couple of years. We're seeing a bigger segment of leisure, changing demographics of people flying with Wizz. Those people were booking sooner. Okay, so you saw that this was happening January, February. Then, of course, at the end of February, early March, the Iran conflict happened, and you saw that there was a flip in the numbers. So now people are taking a much more pronounced wait-and-see approach. A lot of instability in March and April as well. Now, there's other things happening as well during this period, such as Easter and other holidays. But you can see in general that there was a trend towards people booking later. But then May came along, and June's now 11 days into the month, and then we're actually seeing June look similar to May, where people are going back to this planning phase. They're no longer adjusting to the news cycle. They're regaining confidence and looking forward to planning. So that means that for us, we can no longer need to worry about the firefighting, which is kind of what's happening as people's behaviors change. We're trying to predict and anticipate what's happening. We can go back to more deliberate and more measured and more strategic long-term postures. And so that's a bit of backdrop that I wanted you to understand. And so if we believe, which we think that notwithstanding the yesterday's news and today's news and tomorrow's news, we think that people are taking a more planned approach, then that gives us more confidence to be able to look forward and to think about how we're going to deploy this capacity that we have into this half and into the next half. Next slide, please. And so in terms of commercial initiatives and where we're putting our focus, we spend a lot of time talking about our network design and our grow better strategy. So we pulled out of the Middle East, as Joseph mentioned. We're looking at where we can focus on airports with the right cost base to comply with our ULCC structure. We think about productivity in particular, how we can think about our overall network design and the KPIs that we're looking to unlock with the network. So we're seeing more aircraft unparked than we anticipated last December. We're seeing more focus on Central Eastern Europe, more focus on markets that give us the profile that we want. And so we've been very active in Italy in particular, deploying a lot of capacity there because it fits the model. We can be focusing on shorter stage lengths, generating more seats, focusing on better cost management. And we'll look at other markets within Europe that have that characteristic. So we're hunting for those markets, and we can deploy our capacity not so much into exotic exploratory markets, but into markets where we can drive efficiency and start to think more about our customer segmentation. So who is our customer? How are they being served, if at all? How can we serve them better? And those are the sorts of questions we're asking so that we recognize the sheer scale of Wizz nowadays with 266, 67 aircraft in the fleet, with what we've accomplished and what we've become, and how we can become less of a weekend alternative, but more of a daily choice. And so the network design really is the core of the cost management and the cost delivery. And I think you'll see that once we get through some of the challenges with retiring the CEO aircraft and the maintenance costs that come along with that and the higher depreciation that those aircraft carry, you'll start to see some of the improvements come through, as Joseph mentioned, into next year. But reliability is also something that we should be acknowledging. So you can see that I've pointed out what happened in May, but I've also pointed out what's happened in this year's fiscal year to date. We're no longer low on the rankings. We're at the top. We're doing very well, and that's a combination of sheer discipline when it comes to our operations team. And so I want to recognize them for all the hard work that they put in there, and all the lessons that we've learned over the last couple of years. That will help us on costs. You can see that come through on the cost line F25 to F26 in the form of lower disruption costs. While we're doing better in terms of keeping those costs down, what we're seeing is that there's a hangover. There's claims from prior years that are still affecting current years. And so once we eliminate the poor performance and stop generating new claim opportunities, and the legacy claims finally are processed, then we should see that number be even better. So reliability drives costs. On top of the fact that the network design will help drive the cost, because the network design gives us more opportunities to have standby crew, resources when it comes to maintenance, resources when it comes to aircraft, all that stuff will work together to deliver this lower cost base. But also what I think that we need to recognize is that reliability also drives the revenue line. People will pay for performance. People will pay, for schedule quality, for convenience, for having more options. And that's really going back to the network, thinking about how I can grow better, have more density, provide more seats, more options, and become the first airline that people think of when it comes to flying on Wizz. And then lastly, we pioneered something together with Starlink, with SpaceX, in the form of what's called Starlink Managed. It's a ULCC solution, and that is very exciting. We just announced it on Monday. And I'll pause because I'm sure people are going to want to ask lots of questions around that. And so I think it's important to point out that what it is it's a product designed for ULCC principles. All right. So under the traditional model that you're familiar with, Starlink is typically offered by airlines for free. That won't be the case. There will be a cost. Starlink will be managing the sales. We think Starlink are experts in managing the sales of internet connectivity, not Wizz. We will be managing the ancillary opportunities that come with that. Any notion of OpEx costs that you have in whatever you've heard from other airlines, I think you should assume that those are overstated. Again, focus on the ULCC nature of this. And when it comes to CapEx, I'll stress Wizz was part of the design of this product. So we designed it in a way to work for us. And then when it comes to the fuel burn, I think people who have put forward estimates of fuel burn they were wrong in their analysis. Simple as that. We've looked at it our way. We've collaborated with SpaceX. You can see on their website what the fuel burn estimate is, and you should rely on those numbers. Thank you, Veronica. back to you.
So let me take it back
to
to
go.
the next slide, please. Okay, so this is what we are seeing for the first half of the financial year until the end of September. Capacity-wise, as we have commented on, we have Q1 with 15% ASK uplift, translating into 25% more seats. And this is due to the grounding of aircraft and more European flights by this time, irrespective of the Middle Eastern situation. There's a bit of a catch-up in Q2, given that the Middle Eastern capacity gets reinstated there, so ASKs are up 20%, and 25+% seat growth is to be expected. At that point, 30% of Tel Aviv capacity is back, and the rest would be flown in Europe. With regard to RASK, please take into account the Easter effect in Q1. So that's a significant distortion to the numbers. So we are expecting Q1 RASK to be mid-single digit towards high down. We will see how exactly June is going to be completed. Q2 RASK is expected to be flat, around flattish. Performance load factors are expected to stick to last year's performance across the whole of the period. With regard to costs, as Veronika said, we have most of our fuel requirements hedged for this period, and we are expecting cost ex fuel to be flat, maybe a little up, but we are trying to do as best as we can to make sure that we contain that exposure. And I think that closes the presentation. So now back to you for questions. This is the best seat.
Morning, it's Harry Gowers from JP Morgan. Maybe if I open with a Starlink question, and if you could just talk about the economics around it. I don't know what the easiest way to talk about it is, but maybe sort of cost per seat or cost per aircraft, and then how you think about monetizing it or how much to charge for using it. And then second question, your kind of capacity deceleration normalization, I think, has been pushed out by 6 to 8 months, as said on the outlook slide, from winter into next summer. So maybe first, how much capacity growth might we expect at the moment in winter, year over year? And then why has it shifted, and under what sort of environment or fuel price might you consider having to withdraw that growth? Thanks a lot.
Maybe by Ioannis thinking about the SpaceX issue, let me comment on capacity for winter. So I would say that there are at least 3 factors affecting winter capacity. One factor is that we are expanding on short sectors quite a lot. This is a matter of design, and that flows through the winter period. So genuinely, notwithstanding that whatever ASK growth we would be delivering, that would translate into more seats. So the seat growth is inflated over ASK growth, just as a matter of designing the network, especially focused on short route, a lot of Italian and domestic, but also a lot of other short routes. So that's one factor. Second factor is that now we have the confidence how we're going to be uplifting the grounded aircraft, and that will continue to happen through the winter period as well. So we have a very, I think, well pinned down plan to make it as gradual as possible, because we also have to manage our own maintenance capacity and crews in order to be able to take the aircraft back. I mean, you have to put the aircraft through maintenance, and you have to crew the aircraft, and it is gradually kind of spread across the remaining 18 months. So that this is pre-programmed, and that is affecting winter capacity. And the third thing, which is a bit of a flow over from last year, from last winter period, we cut capacity last winter. We felt that given the uncertainty around some of the market issues, we would be more prudent to cut capacity to avoid cash negative flying. That capacity is now coming back, and we're seeing that we are able to churn the network as such, that we are able to uplift our financial performance on that basis. So these are the three sources. So winter will be a high growth environment, but you, I think, also need to look at the flip side of the equation. I think the flip side of the equation is that this year, 2026, is going to be a year of two halves. You see very different market behavior in the first half versus what you're going to be seeing going into the post-summer period. Post-summer, you will see airlines forced to cut capacity and increase fares. And depending on where you are at with regard to your exposure to cost, your exposure to fuel spike, and your ability to mitigate all of those with cash, hedges and technology, you will come out differently here. We're seeing that second half of the financial year will represent significant strategic opportunities for the business. We expect market vacuums. We expect airline failures. We expect significant opportunities to rise for Wizz, very similar to what happened in the COVID period in 2020, 2021. So actually, those two things are getting aligned. So yes, we have high capacity growth, but I think it's going to go against high level of opportunities for the business, given the distress in the industry. Don't forget that from a U.S. history standpoint, the bigger the crisis is, the better off we are.
Okay, so in terms of Starlink, like you can appreciate, the terms are confidential, but it is so exciting and so unique. I think it's first important to recognize where the world is going. People, whether you like it or not, maybe if you're my age, you like it less, but you're going to be connected. We are an ever-connected society. So recognizing that this is where the world's going is important. But also I think that from a differentiation perspective, having internet where no one else does is also something for attracting the new generation of travelers, those who are going to have a much more higher propensity to travel. SpaceX really wanted to work with Wizz because of our seat production capabilities, because of our high utilization, because of our ubiquity, our potential to put them in front of passengers. And obviously SpaceX has other ambitions than just doing in-flight Wi-Fi. And so that's really appealing, and creating this win-win environment that we could tailor the solution for. I'm not going to talk about cost per seat, but what I will be able to point out is that from a position of strength, what we do well is create ancillaries and create ancillary opportunities. And what SpaceX does well is provide the fastest internet available in the sky. And so we wanted to make sure that we went with the best and that we were future-proofing this business for the next decade or so. And so we have a model where, like I mentioned, SpaceX is the vendor, SpaceX manages the portal, SpaceX deals with the sessions, but the model is designed to make sure that the cost for the passenger is affordable, just like our fares. And so while it may not be free, like you now have seen what's happened in hotels and airports, it is designed to be affordable, and is designed to put as many people as possible in front of the internet. What that allows for us is a low-cost, ultra-low-cost solution, so that we don't have the traditional operational expenses. We do not have the traditional CapEx profiles and hardware hurdles that come with the installation. What we are able to do is create ancillaries around that. And so I think everyone's now pretty accustomed to paying by phone, tapping by phone, and accessing payments through that platform. Bring that onto the plane allows us to do all sorts of things on the plane, whether it is processing credit cards in the sky that we otherwise couldn't do, and exposing ourselves to fraud. Now we're no longer exposed, because we can determine whether the customer has a balance in real time. That allows us to lift the caps on in-flight sales, which means that we can sell more and reward our crews more in terms of what they're doing. We can run promotions on in the sky, both on our own products and our own flights, but also with partners, whether it comes through our hotel options on our app, or whether it comes to destination marketing, destination transfers, excursions, things like that. We can do all sorts of new retail concepts. We can also access a lot of the inventory that is spoiled the moment that the door has closed traditionally. So if there's empty seats and you don't fancy your seatmate, you can automatically buy that seat while in flight and move. And so that was a revenue stream that we couldn't access in the past. So there's all sorts of applications that we're in the process of designing. Even one of the things we have right now is in-flight ordering now on our app. You can do that now without Wi-Fi. You can beat the galley cart and get your product, but you still have to pay with the POS. Now we integrate the payments into that, and it creates a lot more efficiency for the onboard experience as well as for the customer. So that's where we're going with that, is the ancillaries. SpaceX wanted us to find a model that allowed us to maximize our ancillaries, so that ultimately we're happy with the product, they're happy with the product, and installations should start across the fleet in the beginning of 2027 and roll out through that year, and it'll ultimately affect the whole fleet as soon as we can get the installation schedule pinned down. So I hope that answers your questions. It's very much designed for ULCC. We very much designed it with our input to make sure it worked for us. It does not the free Wi-Fi model that other airlines, I think there's more than 30 now that have it. We're the only one that has this Starlink managed approach, and we're thrilled to be able to announce this.
And I would just add one more aspect that we are a very large airline for purposes of SpaceX, so we're going to be closing out competition here simply because our installation will occupy the capacity of SpaceX. So anyone else's ability to try to match or anything like that will be limited at least for a certain period of time. So we've seen that we are really building a competitive advantage here, and this is kind of the same what we did with Airbus when we ordered back in those days in Dubai. We blocked over 10% of Airbus's capacity, which I think creates difficulties for all others to try to come in and match. And you see that what happened in case of Airbus, that we got our delivery stream, and then when they were talking about other airlines, they were really pushing back the delivery stream quite a bit. And I think something similar you might be expecting here as well. I'm pretty sure that this model will not stay unique to us forever, because I think it's a very good model. It's very efficient from our standpoint. So some others will be smart enough to recognize that there is something in it. But their ability to implement will be limited, because simply we're just going to be blocking them out as a result of our scale and implementation.
Thanks. Alex Irving from Bernstein. Two from me, please. First, I want to come back on the winter capacity plans. Just because you're uplifting grounded aircraft, just because you cut capacity last year, doesn't mean you have to fly the planes this year in a higher fuel price environment. Of course, every marginal flight happens at spot fuel. The question really is, what metrics are you focusing on primarily to steer the capacity you're looking at? Is it getting cash down? Is it just cash contributing flying? Is it more of a long-term strategic positioning focus? Why is the capacity growth accelerating the right move here? Second question, once upon a time you were keen to grow more and more in London Gatwick. It's all seen in the news on EasyJet in the last couple of weeks. If slots were to become available in Gatwick over the coming months or quarters, would you expect to be able to be the highest bidder for some of those? Or is Gatwick too high cost now as an operation and the current strategic focus and no longer attractive for growth of Wizz?
Yeah, so maybe I'll start with the second one first. So I don't think the Gatwick would list too high on our priorities with regard to growth in the future. Gatwick has two issues in a way. I mean, one is that it's an incredibly high airport cost with constraints. So that limits our ability to refine the operating model and get the maximum efficiency out of the operations at Gatwick. So I think that's one block. And two, now this is stopped with the APD charge increases by the UK government, which is everything but too smart. And I understand that the government wants to create funds for other purposes, but I'm not sure that this is the best way to achieve that. But whatever it is, I mean, this is not our decision, of course, but we have to process the consequences of the decision. So with that, I don't think that Gatwick is going to be very high on our priority for any purposes, and whether anything or nothing is going to happen to the airline you mentioned, I don't know, but I don't think that's going to change our appetite for Gatwick. So with regard to capacity in the second half, I think it's a very good question because you have to effectively contemplate two issues. One is manage the business for profitability on the one hand, but also manage the business for strategic opportunities on the other hand. And those two things may go hand in hand or may go against each other. And this is something to be seen. And we want to reserve the right to be sufficiently opportunistic, if you want to put it this way, that if opportunities arise, then we're going to be in position to act on those opportunities. Remember how we got to Italy in 2020. So all of a sudden, because of the COVID circumstances, the entire industry moved backwards, created significant panic in Italy, and that made some deals, airport deals, attractive to us, which these wouldn't have presented themselves otherwise. And we felt that that was the right way to act on the opportunity against a very weak kind of a competitive backdrop. So we don't know how exactly the situation is going to play out this time around. We have some expectations, and of course you do some calculations and planning around those sort of matters. But I think we're gonna be sufficiently opportunistic to see what is happening and act on the basis of the facts as opposed to just intellectual contemplation. But in terms of managing the business for profit, I mean, that's a very intact principle flowing through. But we are not seeing today, but I think we're going to be seeing it in a few months from now, that you will see more capacity discipline at industry level coming into play in the second half. You will see airlines cutting capacity significantly. I think supply and demand will readjust to a new equilibrium, to a new balance, and that will push fares up. And then the question is, how each of the airlines are affected. We are basically well hedged, flying latest technology, burning the least fuel on a unit basis, and we have significant cash on hand, what we can mobilize. I think that should set us aside from most of the industry. I'm not saying that we are the only one in that position, but I think that should set us aside from many of the other players. And in parallel, we should be able to raise fares needed to cover the incremental cost, but also strategically if opportunities arise. I think you have this kind of a two levers to play with.
Morning, Jamie Rowbotham from Deutsche Bank. Two from me. Firstly, Joe, the CEO of Airbus has been saying that Guillaume has been so focused on the powder metal issue and the maintenance issues on GTF that they're now at risk of not producing enough new ones quickly enough to then deliver their plans for, ramping up A320neo production. Is that something you're keeping an eye on? Is that something that concerns you at all when you think about the path to having a 100% neo fleet? And then secondly, Veronica, I wondered if I could get a steer on maybe a couple of items. The first is sale and leaseback gains, so 250 million in fiscal 26. Looks like a similar-ish number of aircraft deliveries in 27. I'm not sure where you are on the engines, but should we be expecting a headwind or a tailwind on that line item? And then finally, CapEx. Joe, you just mentioned the significant cash on hand that Wizz has. Fiscal 26 was an unusual year with a 780 million credit on the net CapEx line. Should we be expecting something similar in fiscal 27 on CapEx, given the various moving parts? Thanks.
So maybe I started off with the GTF issue vis-à-vis Airbus. To be totally honest, our interest as Wizz is to get the existing fleet fixed before we embark on a new aircraft, because that would just incur additional capital cost to the business by grounding existing capital investment. So that's, I mean, if anything, we are pushing that to the direction what Airbus may not like, but we do, and because we think they have to fix their own issues before they move on to the next chapter on life. Now, probably the good news is, from a Pratt & Whitney perspective, that the other guys are not doing much better either. So this is quite a problematic supply chain as we speak. But we want Pratt to fix our issues with the fleet on the ground right now before we start worrying about any other thing. But frankly, by the time we get to the end of 2027, I mean, largely our fleet will get converted into A321neo in any event. I think the conversion at that time will be over 90+%. We probably will have like another year to go to fully fledge the process of renewing the fleet from CEO to neo. So I have to say that personally, I'm not overly worried. We have our stated delivery stream with Airbus. By and large, Airbus has been delivering against that stream, and we don't expect major issues coming out in the future either. You may have a few weeks of delays here and there, but this is not major. So I don't think that this is going to jeopardize our ability to induct capacity as planned. So I'm actually fairly relaxed by that. But I understand Guillaume's frustration.
Okay. A couple of points on the sale and leasebacks, which are in the other line. In this year, we expect the sale and leasebacks to be at a similar level year on year. We do expect the decrease of the compensation, which is in line with the ungrounding on the aircraft, and the disruption cost also to performing very well in line of the last years. On the net CapEx, yes, this was 780 in F26. We expect a lower number this year due to the lower number of the aircraft deliveries. It was 39 in F26. Will be 31 this year, and as such, the extent of the PDP rebates and will be lower. So this will be a lower impact in the F27. As we said previously, over 2.1 billion of the cash position, which is a comfortable level.
Thank you. It's Jared Castle for UBS. I'll probably limit it to one, just given the time. You've got your CMD coming up in September. It doesn't sound like, or maybe I'm wrong, but there's going to be a change in how you finance between finance leases versus other forms. But can you talk a little bit about what topics maybe you're going to cover, and especially looking forward, some of your competitors, EasyJet's got a PBT target per pax, Ryanair obviously 12 to 14 net income target. How do you think you stack up, in, let's say, a normal market by 2030? I mean, I don't know if there is a normal market for airlines, but where in terms of your ambition would you like to get to? I think somewhere around 5 net income you've got to in the past. But yeah, if you could just give any color on CMD and maybe thinking about future profitability per pax. Thanks.
Maybe I'll start it off, and please feel free to add. I mean, just the last 22 days, I think we are looking at net income and net income margin as a primary metric to drive. And we understand that due to all sorts of issues, we are not at the level where we would like to be, but we think we have a plan in place to get there. So we want to deliver double-digit net income margin, as we used to be talking about before. So I don't think that has changed. So with regard to the CMD substance, I think we have a lot talk about the kind of transitioning ourselves through the issues we have been facing. I mean, we are geopolitically affected, we are supply chain affected, and we are also free transition affected. And I think we want to clarify how exactly those issues we were about time frame wise and economic impact on the business. I think we also have a lot to talk about markets. There have been shifts around that. Going into COVID, we were a Central East European, pretty much pure Central East European business. Coming out of COVID, we became a lot more diversified. Some good decisions, some bad decisions. If you want to put it face value, I would say that you certainly challenged the Abu Dhabi decision, but that's behind us. You certainly challenged the XLR decision, but that's behind us now. There might be a few other things you may challenge, and I think people want clarity how we are moving along those lines. We also want to give you clarity on some of the other levers which we think are fundamentally underpinning the USCC delivery of the model, like fleet utilization, like group productivity, like airport cost, and what are happening and how the market evolution is kind of underpinning those ambitions to make sure that we are back to worst standard performance with that regard. So I think the kind of how we are going through the transitionary matters and how we are solidifying ourselves in terms of underpinning performance metrics, what matters in terms of some of the market issues and some of the underpinning USCC deliveries.
Maybe I'll just comment on the sale leaseback approach. I mean, I think I think that under the circumstances, with all the uncertainty that's going on under volatility, that we'll probably be focusing on how we can best prepare the company to take advantage of the opportunities. So Joe mentioned the fleet, right? We have capacity to deploy if we need to. When there's gaps that present themselves, we want to make sure that we have cash, and we're doing things that we're looking at all sorts of ways to be able to establish a war chest, to be able to go after the opportunities when they present themselves. That, I think, is the best focus right now. And also managing our leverage. You saw that our net leverage came down in the fourth quarter, and so that's something that we want to continue to strive towards. But ultimately, we need to focus on what's right for the company in the particular circumstances. And right now, under the circumstances, we think that putting the company in a position of being able to act and deploy, especially with this growth that we have ahead of us in terms of seat capacity, is probably going to be the focus for the CMD.
And will you give some financial targets over the medium term? I don't know if it's for you, Joseph, or Veronica, or
net profit and net profit margin. Okay. I think that's what we are focused on.
Great.
Munira Kiani from Bank of America. I actually wanted to go back to your leverage comment, and you're at 3.7 now. I understand your gross cash and most of the debt is lease liabilities, but how are you thinking about your balance sheet, and where do you want to get to, and how do you plan to get there? And then on winter capacity, so you've heard from other airlines as well. Everyone seems to think, and someone else will cut back on capacity. How do you think this will kind of work out? And what are you hearing from the EU in terms of regulation around slot rules? Will there be kind of some flexibility on that front to allow airlines to cut capacity?
I'm happy to pick up the second one. So with regard to winter capacity, I mean, everyone's waiting for the order to bring, but I think that is more economic determinations here than that. I don't think this is just a poker game. This is more than that. And you have a lot of empirical evidence in previous circumstances how these things kind of work out. So what do we know? We know that situations like this will make those airlines fall first on capacity, or maybe as a whole, that don't have enough liquidity. They are exposed to the market, so they are not hedge covered, and they fly old planes. When those airlines flying 15, 20-year-old airplanes, they are very exposed because those airplanes are thirsty. They drink fuel like fish. Against a high fuel price environment, that's a significant exposure. So you can scan those airlines, how much money they have, how well hedged they are, and what kind of a fleet they fly. I think you can create your own categories who are most exposed. And these airlines tend to be, not backed by states. They tend to be small, undercapitalized private airlines. They don't have credit ratings. They don't have access to capital, etc., etc. So that's the first category where you should be expecting some problems to arise. Then you have the state-sponsored carriers, the big guys. Those are the first ones who will run to the German government or French government, you name them, and they will show hands that they need money to be bailed out, and they get bailed out. We learned it during the COVID times that they get bailed out, but we also learned that they are forced to make some rational decisions, so they will have to rationalize capacity. So I think you should expect that category to act somewhat rationally, notwithstanding the fact that they will be held by their government. And then you probably have not more than 2 airlines in Europe that will take a break. That gets created as a result of that, and they will jump on these vacuums created, and they will gobble up the opportunities, and we are one of them. And you look at our entire history, we step changed our positions during crisis times, because there are 2 things happening in a crisis. And I think the second half of this year is going to be a crisis. 2 things are happening. One is that competition gets weak. 2, the customer downgrades from high cost to low cost. And this is the opportunity that gets created for an airline like us. And we want to be well positioned for that. As said, we will have a war chest to be able to activate them. But of course, I mean, kind of the way we say it internally that, when you wander in the forest and you bump into a grizzly bear, you don't have to outrun the grizzly, you have to run faster than the guy next to you. So the grizzly is there, but we just have to run faster than the guy. And I think we are running faster than the guy next to us.
Well, that's me.
Our leverage.
Yeah. So that ties into the question from Jared, right? Like if we do switch the financing model, that'll drive leverage up, and then that impacts our cost of debt and also our cash availability. So at this point, look, we're trying to get the leverage down. Our ambition is to get it back to 2 so we can regain that investment grade, because that makes a lot of things easier when it comes to talking to vendors and to describing the business and to presenting things to the market. You just simply say, here's the rating, please focus on that. And it makes all of our lives easier so we can focus on running the business. Why did it go down? Well, we had a very healthy cash generation, helped by certain things, but still a healthy cash generation, and our EBITDA is going up. So if we can continue to deliver on the cash generation, which we will, because we'll be growing and there'll be opportunities there in terms of forward sales. But if we can continue to focus on the net debt number, then I think you'll see that progression. And yeah, there's all sorts of complications that have delayed what the speed of reaching that, and now we have this next crisis to deal with. But for us, it's about making sure that we are able to take the market share, own the market share. We're number 1 and number 2 in all of our markets. We just took number 2 in Italy. And we'll be going into markets where we can quickly try and get to that positioning and deploy, most importantly, the productivity around that. The productivity will ultimately generate profitability, efficiency, and cash, and that should help the leverage at the end of the day.
Morning, Dudley Shanley from Goodbody. Just one question for me. Can I just ask about hedging? I noticed now that you're hedged into FY28, whereas a lot of competitors have said they're staying out of the market because of the elevated fuel price. Can you just talk us through your thoughts on that?
Sure. So on the hedging, as you know, I think we shared that before. We have the hedging policy which has been in place for a couple of years, and to which we stick, because this is the best way how to prevent the peaks and the downturns on the market. So what we do is that we gradually increase the percentages of the hedges, and we do it consistently with the policy. We have done it before the crisis. We have been doing that and taking advantage also of the downward sloping fuel curve during the spikes of the fuel prices. And we continue on that. For us, this is really a security. This is the insurance against the spikes and the movements.
And Dudley, if you're implying that other people are, staying out of it and, given the fuel price, that would then suggest that someone's speculating. And that's exactly why we have a policy, right? So that we're not speculating. So, yeah, sorry.
It's Andrew Locke from Barclays. Can you give us a bit of color around the guidance you've given for the second quarter RASK? So how much advance loads have you got on the books, and how does that compare with what you saw last year? And related to that, really interesting slide showing the inflection of booking trends stretching out again when you got into May and June. Can you tell us a bit about whether that is across your whole network, or whether that is more weighted to Eastern Europe and you're not seeing it in Western Europe or Italy? Yeah, so how is that playing out?
Okay, so in terms of the guidance, you saw from the trading statement that we were building loads already. I think at that point we said something like 2% up year on year when we put the early May statement out. And where we are now for Q2 is close to 4%, so load factor buffer. And so now is the time, especially in summer, to make sure that we manage the yields in order to deliver the RASK. We solve for RASK at the end of the day. And so that's the approach. And so
is that the summer of
that's Q2. That's Q2. So that's to answer your question in terms of advanced loads. The guidance is supported by what we're seeing in Q2 at this point. And so flattish, I think, is a fair number. There is a benefit, of course, of the shorter stage length, but ultimately that's the number that we put forward for the guidance. And then the second question was
Eastern
Oh, right. So that profile chart was for the whole network. And I don't have the breakdown across markets available for you.
But I don't think there is a fundamental difference between market geographies. So I think it's pretty much the same what we are seeing. But this is not unexpected, to be honest, because we flagged the same behavior when the war in Ukraine broke out. That when there is uncertainty out there, people become kind of reflective on that uncertainty. They are not making decisions. They don't know how this is going to play out on their life and what reserves they need to build or mobilize, etc. I think they need to become comfortable with the new set of circumstances, and once they reach that point, then they will default back to the normal. And it takes some time. It is typically 2, 3, 4 months, that kind of a period. And under significant crisis situations, you see the same thing happening. And with regard to the geographical differences, I think this war in Iran is not specific to Central and Eastern Europe. Maybe Ukraine was more specific to Central and Eastern Europe just because of the proximity. But in terms of impact, this war is pretty much across everyone. I mean, Western Europe is not any better than Central and Eastern Europe.
Fuel's not cheaper in one market than the other.
Hey, Axel from Morgan Stanley. One question from my side in terms of free cash flow generation in 2027. So if we listen to you guys, so the fares should be still into negative territory in H1, potentially positive in H2. CASK ex-fuel flat to up low single digit in H1, CapEx lower year-over-year but still elevated. D&A still elevated as well due to the retirement, higher fuel costs. Have it on the map, but where should we end up with the cash flow generation versus the 1 billion that you guys delivered in 2026?
Well, I mean, as you can imagine, we have been doing all sorts of cash flow modeling and stress testing the cash flow modeling. So we think that our cash will hold pretty much where it is at this point in time. I mean, we don't really see, even under the worst case scenario, any significant deterioration. I mean, let's not forget that, cash is a complicated matter. This is operating performance, financial performance of the business. It is also the inflows of significant cash streams or the outflows of significant cash streams. It is also the on-flow revenue, so it matters whether you are growing the business or not. So it's a complicated matter, but we actually think that we have significant cash on hand, and we will remain in that position going through the year. And that's why we think that the notion of building a war chest is important here, because we are in a position, we will be in a position to mobilize resources against market opportunities arising. So cash remains fairly flat, I would say, over the next period, pretty much holding the same level where we are at right now.
I mean, I wouldn't be surprised if it's positive.
So maybe there is upside to it, but certainly not downside. I guess the question is going more towards the downside, but we don't see that. All right. Thank you. You are it is. Thanks for coming.
Thank you.